Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Today, we're taking a little time to speak more about building your long-term wealth. Many of us on several occasions, and in fact in our younger stages of life, focus on things such as acquiring your first car, picking up your first home, or acquiring your first home. And we often pay very little attention to further down the road. In other words, how are we going to prepare for life after employment and focusing on building our long-term wealth. Now, with increasing questions around, increasing news items around the NIB and other factors and questions being called about the social safety net, focusing on building your long-term wealth takes even higher precedent in our view. So let's take a look at how individuals can build their long-term wealth and the options available to them. Now, traditionally, passive saving has been the most preferred approach, which is basically saving money in your bank account, and it's often a very low risk and no return solution to building your wealth over time. Secondly, building up or crafting a personal portfolio is another option. It of course would entail slightly higher risk than the passive savings approach, but offers the potential for higher returns. Now, with the personal portfolio approach, whether you have an investment advisor or not, it does require a bit more attention in terms of managing your investment affairs. And finally, the often overlooked retirement fund solution, which again, compared to the passive savings approach, offers a higher risks, but often the potential for higher returns as well. And it does offer an increased measure of convenience when compared to the personal portfolio construction approach, as well as significant tax benefits. In fact, contributions of up to $50,000 annually in an approved retirement plan or retirement fund can save you on 25% of those taxes, which could be as much as $7,500 per year, or $12,500 per year, in fact. So some of the further benefits of a retirement fund approach is that it comes with professional management. There is the potential for higher returns as discussed. It's a convenient and hassle-free way in building your long-term wealth. It's portable, meaning that if you are not satisfied with your current provider, you can transfer it to another provider, and there are significant tax benefits as mentioned. So does investing really make that big of a difference in building your long-term wealth? Well, yes, it does. If we take a look at this illustration, the blue represents what you would accumulate just by saving alone, whereas the yellow part of the graph represents what you would generate from investment returns. And two things to note here. One is that time is your greatest ally in investing and building your long-term wealth, which means the earlier you start is the better and more effective your accumulation through a retirement fund or other similar plan will be. And secondly, the amount of contributions, and thirdly, the returns that your plan generates for you. So if we take a look, for someone who would have started building their wealth, let's say 20 years ago, or over a 20-year period, they would have accumulated and would just keep saving just around $1,000 a month. They would have accumulated over that 20-year period $240,000 in, let's say, contributions or savings, and around $148,000 in returns generated from those contributions over that particular period, for a total of just around $388,000. Let's say someone started a bit earlier for a 30-year period, they would have accumulated, again using the $1,000 a month savings figure, just around $360,000, but their investment returns would be more than double that of their accumulated savings, around $399,000, to give a total, let's call it a nest egg, of just around $760,000 at the end of that period. And that's using a relatively conservative annual rate of return of just around 4.5%, which is not something that's beyond the realm of achieving in the current investment environment. So investing does make a significant difference, and of course choosing your particular provider for retirement funds is also an important decision to make and will affect your returns. So as we can see, if we take a look at the 5-year returns of some of the major providers, including Bourse and its individual retirement fund, over the past 5 years, we would notice that $100,000 invested at the start of a period 5 years ago would be worth, well, with company A, $106,000 now. And if you go right across to the investment retirement fund in that yellow, managed by Bourse, that would be just around $138,000. Over the past 5 years, retirement funds have generated an average return of just ranging from 2.3% to 5.6% per annum. And that 5.6%, of course, would have been generated by the individual retirement fund. Now, returns do vary over time, as with any investment. And if we take a closer look at the individual retirement fund's performance, for example, we would see that in 2011, there was a return of 7.3%. And returns would have varied between 0.8% and 11.5% over this period. And year to date, that particular fund is up just around 5.2%. And over that 2011 to 2017 period, average returns for this particular fund would have been just around 6.5%. So starting early is a very big benefit to the investor seeking to build your long-term wealth, as well as choosing the right investment provider. That's it for this week's edition. For more information, give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com or check out our website at bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.